Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement, powered by Kuhn Capital Partners, where Wall Street noise gets cut and real financial strategies begin. It is hosted by myself. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We are bringing you institutional level investing strategies, tax reduction, and risk managed strategies to individual investors. If you're serious about keeping more, growing smarter, retiring better, you're in the right place. Let's go. If you'd like to get on our calendar, certainly we would love to have an initial conversation with you. 630-492-1912 page will certainly set that up. 630-492-1912. The income banknote market is very, very strong. As you know, we are the go-to, in my opinion, providers of those types of strategies. Those are strategies that can still deliver positive returns in negative markets. As long as the indexes are not down 30%, you're still getting your annual interest payment. We're seeing those price anywhere in the neighborhood of, we did do one, like I mentioned a couple of weeks ago with JP Morgan. It was 15.45. That is an anomaly, but it did happen, 15.45. But we're still seeing 12 to 14% pretty consistently amongst the big banks. So if you'd like to learn how to incorporate that, I don't know why every single person doesn't have that inside of their portfolio. The minimums are only $1,000 now. 15.45 was one that we recently did. But again, it's a strategy that, given this market, if we're when it's one of the things I really want to focus on today, I want to go over kind of what my thoughts are on the market and how we're addressing that for our clients. And I also want to go over tax reduction. If you've listened to the show, you know that we believe tax reduction is one of the most overlooked area of financial planning. Again, we're not CPAs. We cannot provide tax advice. So a best practice, anything that I talk about as far as tax reduction goes on the radio show, it purely is for educational purposes only. Best practice is always reach out to your tax accountant or whoever you receive your tax advice from. But it is, in my opinion, the most overlooked area of financial planning. We are planners. We are planners first. We are financial planners first. And the biggest impact that we are making in individuals' lives that come to work with us is, what I believe at least, is incorporating defined outcome strategies. Those are strategies that have some sort of a defined outcome. We classify those as protected growth. We have strategies that are principal protected. As you know, we talk a lot about annuities. We talk a lot about income annuities and how I believe that those illustrations are smoke and mirrors. And given the outreach of individuals who have reached out to us that they've been sold a income annuity and they were promised all of this, crazy growth, and it's not growing at all or very limited growth. We are really, we have a strategy to fix that, to at least put something in front of you that we can at least do something with that money rather than, the little bit of money that you're making. You can't get enamored. You can't get blinded by that guaranteed lifetime income. Guaranteed lifetime income, man, it's probably the most powerful words of investing, at least for many individuals. But you have to understand that you're only taking your own money out until that account goes to zero. Then you're in the insurance company's pockets. I see far too often people are telling me when they tell us they have an annuity that it grows at 7% a year, 8% a year, 9% a year. I have a newsflash. It's not guaranteed growing at that rate. Maybe for your income number, never, ever for your real money. And so what you don't know is that, well, you probably do know if you've owned it for a couple of years, that there's very, very little growth. and they're limiting the distribution side, and so they're making sure that that account does not run out of money. So if you do own an annuity, we have some strategies that we are able to put something in front of you on overcoming that surrender charge, because in many instances it's pretty significant, 8 to 10%. So we want to make sure that, and again, it all comes down to math, and it could make sense to pay that if you have an investment that has a predefined outcome in something else, like the bank notes that are going to pay 12 to 14% with 30% downside. So those are the things that we're doing for individuals. I didn't expect the outreach from people to be as much as it has with annuity owners. But if you do have an annuity, you do have a lifetime income annuity, that's what we want to focus on. Certainly give us a call, 630-492-1912, 630-492-1912. You can't say that we don't like annuities. One of our protected growth predefined outcome strategies it is an annuity. It's an index annuity, zero fee, but it's only a 5-year, and it's tied to the S&P 500. So it's not one of these fictitious indexes. And that's the problem with the industry, is that the illustrations that you're looking at, those indexes are not actual performance in many instances. They're all back tested. So I've seen an annuity that showed 12% a year, over 12% a year. But when you look at the actual real performance of those indexes that have only been around for a handful of years, it was flat to negative, maybe up 1%. So that's the problem with the industry. I wish that they didn't show you those hypothetical illustrations on back-tested numbers, but they do. So 630-492-1912, and we certainly will be able to do some math for you on your behalf and really educate. So, but protected growth, so that 5-year annuity, I can't tell you how many people find it so appealing that they own currently. Again, it fits in our protected growth bucket, just like the structured bank notes. There's a predefined outcome, like the bank notes. You're going to get that interest payment as long as the indexes aren't down 30%. So it's going to be 12 to, last year, we did 11.5 to 15, 12. Really within the last year, we've done, 11.5 to 15.45. That's a predefined outcome. You know the rules of the road going in. You know you're going to get that interest paid monthly as long as the indexes aren't down 30%. Pretty easy. But the other index annuity strategy that we're using in the protected growth, and that's why people have a real hard time pigeonholing us into the anti-annuity firm, is because it is an annuity. It's just a very short-term annuity, and it's only tied to the S&P. Everybody knows the S&P 500, and so currently you're getting the first 10% on an annual basis of whatever the S&P 500 does. Again, it does not include dividends, so that certainly is a downside, of course, but you get the first 10% of the return of the S&P, and when you get that gain is locked in. And in markets like we've experienced, in markets like we may continue to go through for some money, that's a great hedge to your equity strategies, which are probably down, just like ours. Equities are equities. They're going to go up and they're going to go down. Now, historically, past performance doesn't mean a lot or nothing actually about future performance, but our past performance of our models that we utilize, all third party, have significantly outperformed the S&P. So again, qualifier, past performance isn't indicative of future results, but they have. And one of the reasons that we're very confident with those strategies is simply because they're quantitative in nature. They're not gut feel. They're not, I think this works or I think that works. They're mathematical models. And I believe that the most repeatable strategies of investing are mathematical models, especially when they update those mathematical models. Generally speaking, they only get better. So that index annuity strategy may not appeal to me so much at 50 that it's, 10%, but I'm not going to sell away 10% and act like that's something that's not so great. My goodness, it is, there's a ton of people that, that are sitting in CDs, that are sitting in bonds. Especially that, we talk about asset allocated models. We talk about the bond market. We talk about how the bond market has been in the worst 5-year performance bear market in history. A lot of these bonds strategies are only annualizing anywhere from 1.5 to not even 2% over 10 years. And if your advisor is still utilizing those strategies, you have to question why. Again, conventional wisdom is great for the advisor. It allows them to scale. It allows them to grow. Chances are they're not investing their personal money that way. They're not investing their personal money in the way that they're advising you. So, yeah, that annuity strategy is phenomenal. So if you're happy with up to 10% with no possibility of loss backed by, the issuing company, it's certainly not FDIC insured by the government, but by the issuing company, and you, when you get a gain, that gain's locked in, so you never give it back. Listen, who am I to tell you that that's not a good strategy? What I have found is most larger RIAs, which we're a registered investment advisory, we're a fiduciary. Most firms don't offer those because they pay a commission. And now you don't pay it. I mean, I say that, but I mean, it doesn't directly come out of your money. I think we all pay for it somewhere, right? But if you put in $100,000, $100,000 goes to work for you. But advisors like us don't want those commissions. We'd rather have a fee. But why is it that how I am compensated or what's best for me is going to dictate what we show you, the investor? Again, our job is to lay the data out. And it's like with our financial planning software. When you retire, or if you're within 5 to 10 years of retirement, or you're in retirement or even taking out your RMDs, you understand if you have a 7-figure IRA, how big those taxes are going to ultimately be. I'm amazed that individual advisors are still not showing the benefits of Roth conversions. And we can do that. Mathematically, we can do that. Again, we're not CPAs. We can't provide tax advice. The financial planning software that we utilize is as cutting edge as anybody has, but we also use a tax planning software as well. So we can really look at what tax bracket you're in, and we can really look at exactly how much we can convert without bumping you up to the next tax bracket. So when you have a plan that runs your income out to 95, and we can, based on basic growth assumptions, show you what your RMDs are going to be, you have a multiple seven-figure IRA, you're going to be paying significant amounts of money in taxes, significant. And if we can show you side by side how we can cut that down 50%, 75% by utilizing Roth conversions, we're not saying that you have to do it, but you need to see the data. So those are the things that we're doing. We're going to talk about tax strategies. We're going to talk about the market. We're going to talk about the temperature of investors this show. And thank you for being with us. If you'd like to schedule some time to talk, certainly just get on my calendar. You can give Paige a call or Jenny, 630-492-1912, 630-492-1912.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement, powered by Kuhn Capital Partners, where the Wall Street noise gets cut and real financial strategies begin. I am your host, Robert Kuhn. I'm also the president and founder of Kuhn Capital Partners. We're a fiduciary. We're bringing institutional level investing, tax reduction, and risk-managed returns to individual investors. If you're serious about keeping more, growing smarter, and retiring better, you're in the right place. So let's get to segment 2. If you're not working with us, there's a good chance that you probably have experienced a level of stress. You've experienced a level of uncertainty. And we're talking with individuals who are 1 year out, 2 years out from retirement, and they still don't have an income plan. I see far too many individuals who have $2, $3, $4, $5 million IRAs that still think, well, I'm in too high of an income tax bracket to do a Roth conversion. Make sure that you know the math going in. And that's, what we're good at. That's what we show everybody. And we can show you by making sure that, we can factor out your lifetime RMDs all the way out to age 59. Now, again, there's an assumed growth rate there that nobody really knows the future. So we have to be cognizant of that. But for those individuals who have, seven-figure and multiple seven-figure or $500,000, IRAs, I mean, we have to talk about Roth conversions. It doesn't matter if you're, 5 years from retirement, if you're in retirement, or if you're already taking RMDs. I mean, we have strategies that can mitigate the tax hit. We have an energy strategy that can reduce your taxable income by, generally on average $70,000 to $90,000 per $100,000 invested, and that's active income or passive income. I don't know of a single other advisor, certainly in the Chicago area and maybe even in the Midwest, that has that type of a strategy. And here's the beauty. It's our fund. Now, it's totally separate than Kuhn Capital Partners. For those that have invested in energy in the past, you understand just how strong they are. The government is subsidizing energy investing, and that is what, drives, those on the left so crazy. Very high-level private equity-esque risk-managed strategy, investing directly alongside of the Exxon, Chevrons, Conocos, Occidentals, Mewborns of the world, the majors, in their projects, literally in their projects as an owner. And you're going to get significant tax benefits. If you don't even have a Roth that you want to convert, well, okay, the tax benefits are still great. If you're a high wage earner and you're a physician or an attorney or, making, $500,000, couple $1 million a year, you sold a business, sold a property. We need to have these conversations because it's what you keep. If you're working with a big bank, if you're working with a big brokerage firm, they are not bringing you proactive strategies to greatly reduce your taxable income. I know that for a fact. So $70,000 to $90,000 per $100,000 invested, it is a strong story. And then, we're targeting double-digit distributions, and it's a relatively shorter-term investment, 2 to 5 year type strategy. So you don't need to write a private equity, company that is doing this exact thing, $5 million. We can do it for a minimum of $100,000. So it's certainly something, again, that you really need to make sure that, you're hearing, at least if you kind of fit that criteria. 630-492-1912, get some time on our calendar and let's have, that conversation. So we're seeing with the market, my fear is, let's shift, kind of to what I think is going to happen in the market. And again, it's free advice, so, take it for what it's worth. My crystal ball may not be any better than your crystal ball. But what I think is going to happen going forward is I do think at some point there will be some sort of tariff deal. I don't know if it's going to be, tomorrow or if it's going to be in 6 months, 6 years, whatever. But I think they're going to certainly get it fixed. I don't think they're going to let the markets, drop 3 to 5 to 7%, daily, weekly, monthly, et cetera. But they could, I guess. But what my fear is higher inflation and lower growth. Now, that no growth is the definition of stagflation. And, people are starting to throw that word around, and that is a challenge. And that is something that we really need to make sure that if we're in that period of no to low growth with very high inflation, that you still have something inside of your portfolio that can deliver some sort of returns, defined outcome returns, that you have some sort of an equity strategy that can take advantage of the volatility. I think index funds are going to struggle. I think index funds are going to struggle. I think index funds are going to struggle. I said it 3 times. My belief is that active management, even in the best of times, our active management strategies historically have outperformed the S&P. So that philosophy that you can't beat the market, yeah, most don't. Most advisors don't, because they're just doing some sort of a closet index fund strategy, and they are then charging a fee on top of that. So yeah, most advisors don't talk about performance. Most advisors simply, are underperforming the market. But there are strategies that can greatly outperform the market and have over an extended period of time. We're talking, 20 years, 25 years. And so, if we do have stagflation, we need defined outcome. We need strategies that can historically on the equity side have been able to outperform the market. We do need strategies that are alternative. Alternative doesn't mean negative. It doesn't mean small. It doesn't mean, that only, a handful of people are doing it. I don't even like the classification of alternative investments. You look at, endowments, you look at institutional money, you look at investors that have, north of $10 million, and you look at the exposure that they have to the private markets. You look at the exposure that they have to private equity, that they have to, private credit, that they have to real estate, that they have to, energy. It's significant. And our mission has always been on the radio show is to give that, $500,000 investor to $10 million investor the same strategies, the same type of strategies that the high net worth, the ultra high net worth are afforded. And if you're with a big brokerage firm in your private wealth management over $10 million, we will put our tax benefit, our tax strategy head to head with anything that they're bringing you. I can guarantee that they're not bringing you strategies that can reduce your taxable income $70,000 to $90,000 on average per $100,000 investing directly alongside of the oil and gas majors, the likes of Exxon, Chevron, Conoco, Mewbourne, EOG, etc., in the best oil field in the world, the Permian Basin. And we are simply a owner of their assets. So we're letting them do what they're good at. Seriously, you have 5 to 10 million, let's have that conversation. And we're going to show you how proactive, how cutting edge are the private wealth management sides of the big banks, the big brokerage firms. I know this. I know people. I mean, we have associates, colleagues rather, that work there. So we know the answers to these questions. So our job is just to get you to understand that you really, in many instances, you just have a glorified index type strategy. You may have some private credit, you may have some private real estate, but how's that worked out for you? And, how are those, or what, tax strategies are those bringing to you? Can you reduce your taxable income $70,000 to $90,000 on average per $100,000 invested, your active or passive income? So, if that is you, which there's a lot of those individuals, one of the things about Chicago that we find so fascinating, we talk with individuals who, we had a conversation with someone who said, I never made more than $90,000 in my life, and I've got $10 million. The Midwest is full of amazing savers, and we absolutely love that. You'd be surprised how many 1 to 10 millionaires there are in the Chicagoland area. And you're not getting, the most cutting edge tax strategies. And, everybody wants to talk about fees. I mean, fees are the last thing that I look at generally when I'm looking at an investment that I'm considering personally. We have to make sure that, we are reducing your taxes. When you look at converting to a Roth, I see far too many people that have 7-figure IRAs that are not utilizing Roth conversions. Well, they may not be doing it because they don't have a strategy that they can invest in that can reduce a lot or all of that conversion income. I mean, yeah, that's a competitive advantage that we have. That is a competitive advantage that we are going to start to stand basically on a street corner and talk about. Because when we can show you that you can, if you've got a multi-7-figure IRA and you're going to pay, to age 95, now, obviously we don't know how long anybody's going to live, but if we run that out to age 95, you're going to pay the government, just based on a very achievable growth rate, $3 to $5 million in taxes, in lifetime taxes. And we can show how we can cut that down almost entirely or something much more manageable in the $1 million kind of range. And then you look at a wealth transfer strategy and you look at what is the greatest way to get your IRA assets to the next generation. It's in a Roth. Think about that. They have 10 years that they can let that money grow tax-free and then pull it all out tax-free. Think about that. I mean, just absolutely blows my mind that, more financial planners, more investment managers are not having those conversations with clients. And it starts now. So those are the things that we're having a lot of, of our conversations based around. And that's what you're not going to hear on the radio. On the radio, you can listen to all the shows. I mean, they're in, short of one that I know of for sure. they're just an annuity wrapper. I mean, that's a pitch, wrapped around but disguised not to be an annuity, but it's an annuity. And it's going to, everybody's going to tell you why it's the best thing since sliced bread. So with that being said, we're different. Give Paige a call, 630-492-1912. More after the break. You're listening to Destination Retirement. It is powered by Kuhn Capital Partners, where Wall Street noise gets cut, real financial strategies begin. I am your host. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're a fiduciary. We're bringing institutional level investing, tax reduction, and risk management to individual investors. If you're serious about keeping more, growing smarter, and retiring better, you're in the right place. So welcome to segment 3. A couple things that I want to, make sure that we're talking about. I often think about what's the biggest lie in retirement planning. I think one of the biggest lies, at least in my opinion, my belief in retirement planning, is why just ride it out doesn't work. Certainly doesn't work anymore. And I think we need to break down why hope isn't a strategy and how risk-managed portfolios can outperform even in volatile markets. That, to me, is our core strategy, is our core belief. So I think, one of the biggest lies in retirement planning is, why just ride it out? And, so you've got those asset allocated models, these strategies that are, equities and fixed income. Fixed income is, how's that done for you? Why would you tie your money up in a fixed income strategy that is, annualizing under 2% a year over 10 years? Under 2%. If you're working with an advisor and you own fixed income, ask them what your 10-year performance number is on that. Literally ask them that. And you're going to see in most instances, it's 1.5 to 2%. You need to make sure that you have other strategies. It's like the banknotes, right? I mean, the banknotes are a great alternative, a great fixed income replacement where we're getting, double digits, 12 to 14% with 30% downside. If you believe that, you have an advisor that sits there and tells you, well, don't worry about it. You only need 5%, 7% to beat your plan. Don't worry about the market, the fact that the market was up double that. Nobody is saying that it's not long-term. But why shouldn't you have predefined strategies inside of your portfolio? Why shouldn't you have strategies that are principal protected, are going to give you 10 to 15% interest payments a year with 30% downside protection? So if you're working with an advisor, if you're managing the money on your own and you're still utilizing market averages as an excuse for losing money, I challenge you to reach out to us and have that conversation. 630-492-1912, 630-492-1912. Because again, we have to cut taxes. We have to cut taxes in retirement. And guess what? Every strategy that we're talking about, these are not cutting edge strategies. These are strategies that have been in the tax code in some form since the early 1900s. And when you look at energy, when you look at the oxygen of the world, oil and gas, it is not going anywhere. If you haven't watched Landman, give it a watch. I'm here to make money. Making money isn't Republican, isn't Democrat. Paying less in taxes isn't Republican, isn't Democrat. And so when you are nearing retirement, or if you're a high wage earner, if you're in your 40s or 50s or 60s, you're still working. If again, we've talked so much about it. Actually, I haven't. I haven't talked enough about it. I have not talked enough about the Roth conversion strategy. The conventional wisdom from advisors is wrong. I've seen it. I hear it. We meet with people and they'll tell us, well, my advisor said that, it didn't make sense. It didn't make sense. I mean, did they, run out your RMDs for, your life to age 95? Did they show you that if you have $500,000 to a couple $1 million IRA that you're going to be paying, $1 to $3 to $4 to $5 million in lifetime taxes, with just a, assumed growth rate of, 6, 7, 8%? And, our job is to let you keep more in taxes or pay less in taxes, keep more in and nearing retirement. And so we have the energy strategy. That is such an ace in the hole for us, that we can reduce your taxable income by $70,000 to $90,000 per $100,000 invested. Is it an advanced tax strategy? I don't think so. Not something that's been in the tax code in some form since 1913. I don't think I would call that cutting edge. But I just know that most people don't have access to it. And most people, if you do, generally speaking, you're going to have to go with a private equity type strategy. And they look at energy investing in a much, much different way. This isn't wildcatting. This isn't speculation. This isn't Jim Bob, which that's not to put a dig on Jim Bob. I mean, let's call it Rob Bob. I mean, me. We're out here in, some obscure place trying to strike oil. I mean, that's not this. This is investing directly alongside of the likes of Exxon, Chevron, Conoco, EOG, all of them, the majors in the best oil field in the world, the Permian Basin. And we can take pieces of their deal only because they don't own 100% of their deal. They never, very rarely will own 100% of their deal. And it's very simple to understand why. It's just they don't own 100% of the land. There's always someone that has minority interest. It may be 0.5%, 1%, 3%, 5%, whatever. And those are the interests that we're buying. And so it's actually investing heads up directly alongside of those majors. And guess what? You don't need a $5 million check to do it. You need it, $100,000 check. And we're on the custodian platform of Charles Schwab. Now, Charles Schwab, other than us meeting their initial requirements and due diligence, they don't make a habit of recommending any private investment or any hedge fund or any other type strategy. So, take that for what it's worth. But, we have met their criteria. We do have third-party fund administration, third-party audit, third-party accounting. And so my belief is it's as clean as it gets, and it's as unique as it gets. So we've got to talk more about it. There's a lot of people in the Chicagoland area that we're bringing these strategies to. The banknotes and the energy strategy is generally what piques people's interest. We do dinners throughout Chicago, and we do, obviously the radio show on a couple stations here in Chicago. And, when you can talk about strategies like the JP Morgan banknote strategy, 15.45 that we did a couple weeks ago, you get that interest payment monthly. Well, it's annualized, but annually, but you get it paid monthly as long as the three indexes that note tracks are not down 30%. That's 1.28% if my math is correct. 1.28% a month, as long as those indexes aren't down 30%. How is that as a bond alternative? It really could be an equity alternative. 15.45, my goodness. But how would that be for a bond alternative? And if you're not being shown those strategies to at least have a conversation, then you need to call us, 630-492-1912. And the beauty, $1,000 minimum. Now, we don't do $1,000 notes, of course. Generally we're going to do, what the way these work is we commit to a certain amount as a firm, and whether one person does it or 50 investors do it, it doesn't matter to us, but we do it in scale. We do it in size. So you're getting a better rate. And as an independent, we don't have the big banks, the big brokerage firms that are taking their 0.5 point, 0.75 point out. So if we're going heads up with a big bank or a big brokerage firm, generally speaking, we're gonna win, and we're gonna have a better rate, because it's so funny to me. I hear over and over again. I'll talk about that JP Morgan note again, 15.45%, and we will get JP Morgan private clients or individual investors that are working with the bank, and it'll be like, why didn't they show me this? Why don't they talk to me about it? And I'm like, I don't know. That's it's there. It's not a it is a custom note, but it is backed by that bank. Whatever bank we use, it is backed by them. And as long as we believe it's a systemically too big to fail bank, whatever that means today, that the credit is good. We're very content with the credit of JP Morgan. We're very content with our investors knowing that as long as those three indexes that note is tracking are not down 30%, you're going to get 1.28% a month. And so those are the things that we're bringing to the table. So fixed income, I think fixed income needs a makeover. And you hear it often. You hear it talked about, certainly by individuals, advisors, and what they do with their own money. But you hear it even from, we're starting to hear it, more and more from, the Wall Street community. How have those target date funds been for you? My goodness, those target date funds I've seen hurt and bite more people over the last 5 years if you're close to retirement because they have to shift so much more to fixed income and what has happened, in fixed income. So I think fixed income needs a makeover. I do think that people should wise up. Advisors still haven't, because it's, people will ask us, well, why doesn't everybody do the banknotes? Well, they're a ton of work, an absolute ton of work. Because remember, these can get called within 6 months, and they're always called. When they're called, they're always called for what you paid for it, and they're a tremendous amount of work for us as a firm. If you do them, year over year like we do, think about how much we have coming due often. And now with the market being down, we may own these more, longer than 6 months, right? So maybe 6 to 12 months on average, but they're just a lot of work. And so it's my belief that advisors are lazy. My advice or my belief is that advisors don't know that they don't really know what they are, and I'm shocked by it. I mean, I had another advisor, and we were in a competitive situation, and he told that investor that he's never heard of these strategies, and I'm thinking, my goodness. I mean, that guy's, I don't know if it was a guy or a girl, but that advisor is from the Stone Ages. I mean, I guess these were cutting edge in, the early 2000s when we, first started doing them. But they're not cutting edge today. They're just not mass marketed. And advisors generally want to do what's easiest so they can implement their strategy at scale. They want to get to $1 billion, $5 billion, $10 billion. And it's, again, does it sound nice? Does it look nice on marketing? We have, 20 billion, we have 200 employees, blah, blah, blah. Yeah, of course it looks nice. But, those are typically personally the funds and the firms that I run from, because the customization's just not there. And generally they're going to have their own proprietary money managers. And how is that going to work if they need to get fired? So more after the break. 630-492-1912, 630-492-1912.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. I want to thank everybody, obviously, for joining us. This is segment 4 of this week's show. Hopefully you have something that you've gotten out of the show, and we can help in any way. So 630-492-1912, 630-492-1912. So I think if we sum up this show so far, I know last segment I think was really important. We title it The Biggest Lie in Retirement Planning, the just ride it out phase. It's an issue. I think it's an issue. I think it's only going to become more of an issue with the market possibly not just rip-roaring up and up and to the right without any longer periods of market weakness. Taxes. We want to pay less. We want to incorporate strategies that are going to reduce your active or passive income. And then obviously the banknotes. The banknotes are just so critical and such a strong strategy in this market. So last couple of things I want to talk about, before we close the show this week is retirement. It really is a math problem. It's not a feelings problem. And I think it's so critical because so much of investing is gut feel, is, well, I think I'll wait till this, or let's not start until, this month because it's easier. And all of that stuff works if the markets don't ever go down. I mean, it does, and individuals are conditioned, especially over the last handful of years, that the markets really just simply go vertical. So retirement is a math problem. It's not a feelings problem. And I think that, we need to try and remove the emotional side of investing. And when you look at our strategies, you look at the protected growth, you look at the growth plus, the tax, and alternative. So those are 4 distinctly different strategies in a single relationship with a single client. And when you think about it, I believe that's all any investor wants. I think any investor, all they want is consistency of the outcome. The reason they don't get consistency of the outcome is because the strategies, you may be told they're customized, they're proprietary, which I think is a pretty significant issue if 100% of it is proprietary. But you may be told it's cutting edge, it's marked up as very, very custom, but yet it's the market. It's the market. It's the market. And you're just paying for the right to track the market up, track the market down. And that is my concern. That is my concern that many individuals are going to, that they have, but that they're going to experience, over the next, handful of years. Because I think one of the consistent things that we continuously hear is lower growth over the next 10 years, lower growth over the next 10 years, lower growth over the next 10 years. And that is something that concerns me. And if you have a portfolio strategy that is simply asset allocated based, meaning you own equities and bonds, you are going to have a hard time competing against strategies, or those advisors rather. They're going to have a hard time competing against us when we're bringing 4 distinctly different strategies, 4 distinctly different return drivers. While it may not be perfect, I mean, I don't think there is a perfect investment, but the ability, the probability for us to deliver more consistent outcomes is, again, our belief is just going to be significantly greater than those advisors that are just talking about, well, it's the market averages. It's, we own some equities, we own bonds, we own small, we own mid, we own large, we own international, emerging markets, blah, blah, blah. They're going to have a hard time. Those advisors are going to have a hard time competing with us. And so if you are with that type of an investment advisory firm or group of advisors that work within a bank or a big brokerage firm, now is the time to do some soul searching. Now is the time to do some competitive analysis. 630-492-1912, 630-492-1912. Because you could have $500,000, you could have $5 million, you could have $10 million. And you'd be amazed how basic your portfolio is. Why is that? It's because we see it. We see it over and over and over and over again. So, that's a concern because what billionaires know that your advisor doesn't know? That's another talking point that I thought was kind of catchy, when I read it. I mean, to me, I thought it was pretty cool. But the institutional playbook is really being revealed with, you look at the endowments, you look at pension funds, you look at larger high net worth pools of money. I mean, the playbook is there. It's private energy, it's private credit, it's private real estate. It must be, in our opinion, audited. It has to be third party, and there has to be risk overlays. And when we can look at risk overlays, and what we mean by that is that the ability to create more consistent outcomes isn't dependent upon just one thing happening, where you basically have an airbag. You have brakes that are cutting edge. It's like flying in a plane, I guess. There's backups to backups to backups. I mean, literally, I was watching a video and it talked about landing gear. In the last, I don't know if it's the third or the fourth, option. If you can't get the landing gear down, is I'm going to oversimplify this. So the pilots out there, please understand this. But basically, you just let gravity take care of it. You pull a button or pull back a lever or whatever, and gravity takes care of, the landing gear. So you have to look at that like your portfolio. What backups do you have to your backups to your backups to still be able to create a more consistent outcome? And unfortunately, most don't. And that is just the challenge. And it's good for us. It's really good for us selfishly because it keeps us busy. It allows us to consistently help more people. And, that's what we're doing. And we talked a lot about, in January, how, we're going to shine a light on performance. We're going to shine a light on, lazy advisors who, just have asset allocated models and you're paying a fee for that. And they don't deserve your business. And we really, really believe that. And we say it humbly. But, we're in a game here, in an industry here, where we have to deliver consistent outcomes. We need to deliver, at least some of our portfolio needs to be able to deliver, either A, principal protection, or B, positive returns, even if the markets are down. And, again, the banknotes. I mean, think about the clients, the investors that we had that were able to take advantage of that JP Morgan banknote, 15.45, as long as the three indexes weren't down 30%. How would you feel being able to have that inside of your portfolio for 10% of your money, 30% of your money, whatever? Or do you just want the same old fixed income? So, I think, what we're starting to see a lot of is many advisors out there are just cheerleaders. I mean, that's all they are. Advisors are cheerleaders. And that's not to say anything bad about cheerleading. I mean, but you must know that if your advisor is a cheerleader, they have nothing inside of that portfolio that will do well other than when the market goes up. And that is what we talk about when we talk about closet index funds and how, if your advisor is doing nothing more than saying, on average, the market's going to do this, you're going to be fine, then you have a closet index fund strategy. When our client reviews, we do a spring review and a fall review for the bulk of our clients. Some want more, and that's fine. But for the bulk of our clients, we do a spring and fall review. And our reviews currently for this year, we don't like the fact that the equities are down. No doubt about it. But you know what we're able to point to in the portfolio is the two protected growth strategies. And for those that have the energy strategy, that strategy, the banknotes are still paying. And the market's down, and they're still making money. And then you have the principal protection strategy where we don't even need to worry about the market downside. Now, you give up some of the massive upside. Again, you get the first 10% of the upside of the S&P, not including dividends, but that's still strong. And then you have the energy strategy that gave significant tax benefits, but is still, double-digit targeted distributions. So yes, our equities are down, but we've got three other buckets or three other individual strategies that haven't been directly affected. So think about that kind of a review call versus the review call that you may be having with your advisor now that is just simply saying, sit and wait, it's going to come back. Well, we're certainly saying that with our equity bucket. Again, we're not trying to time the market day over day. Historically, our equity strategies have greatly outperformed the S&P over a long period of time. We manage those managers to make sure that style drift and methodology hasn't changed, but we're able to have positive conversations even in this market with a chunk of our strategies, and that's what we're doing. So with that being said, we hopefully got something out of the show. Hopefully you recognize that all advisors aren't created equal. And if you would love to have we would love for you to have a conversation with us if you see fit. You can do that by giving our assistants a call, 630-492-1912, 630-492-1912. If you take something that I talked about and it betters your situation in some form or fashion, then I think I did my job. So have a great week. We'll be back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.